inflation pick up a little bit in the short term as a result of the cyclical recovery and all the stimulus that's undertaken as a result of COVID-19. But we think in the long term, inflation's likely to stay low. There are quite a few structural reasons why we think this is going to be the case. Some of the reasons are similar to the Japanese situation over the last 30 years, but some are a bit different as well. If you look at the main factors, tech innovation, basically better products and services at lower prices, that's deflationary, good deflation, but it is deflationary. And we think the world's facing a radical period of disruption and innovation over the next 10 years, probably the most disruptive since the second industrial revolution. Another factor is the pricing power of human capital is likely to decline over the next decade and beyond that. And this is because robots and software, including AI, are getting better. They're going to disrupt human capital markets and mean that human capital has less pricing power. This is different to the second industrial revolution, where it was really a dumb machine that humans could leverage and destroy jobs in one area but create them in another. It's very different when you've got machines that are getting smarter than humans and can do things much better than humans in terms of thinking and processing information and making decisions. So we think it's a different situation to the second industrial revolution. So we think that that's going to put downward pressure on human capital pricing. The marginal cost of energy is another factor. We think that that's going to trend close to zero as a result of wind, solar experiencing double-digit cost declines over the next decade and beyond. Batteries are also going to get much cheaper, and we think distributed energy networks are going to result in significantly lower retail costs for energy. So obviously energy is at the core of a modern society. Lower energy costs will flow through into the cost of most goods and services that people buy. Also, the cost of transport is likely to go down over time as ownership of EVs and autonomous driving software enables human drivers to be removed from the cost of transportation. An additional factor is just low aggregate demand growth. We think that that's going to be disinflationary, and that lower demand growth is really a function of those factors that we've mentioned before: ageing populations, high debt levels, hollowing out of the middle class, and also environmental constraints. So those sorts of factors are similar to what Japan's experienced over the last 3 decades. In regard to money printing, we think money printing is unlikely to increase inflation because there's weak aggregate demand growth that is underlying the economy once you get past this cyclical recovery that we're going through at the moment. So you can see that in the velocity of money. It's continued to decline in most major economies around the world. So, and that effectively means that the governments might be printing money, but it's not actually finding its way into the real economy. So therefore, it's not inflationary.